Welcome back to the Peterborough Estate Planning Council's presentation, Your Estate Matters, and today's topic, Seniors and Tax. Joined by Stephen Bark, I'm Peter Lillico. When we left off, Steve, we had talked about a variety of issues, including avoiding quarterly installments and some special advice for snowbirds. But one thing that's common to almost all seniors is that they will have some pension income. You had, I think, a question that came actually from a real living person that had to do with changes to the rules on pension withdrawals?
Yes, Peter. A lot of our listeners may be aware of in the papers over the last 4 or 5 months about the complaint that the withdrawal from your RRIF was too high, that a lot of seniors didn't want to take the legislated amount out. They want to preserve their RRSP. There's also an investment component then, obviously, to that question, because on the one hand, you want to make sure you have RRSP left to fund your, as long as you live.
Right. On
the other hand, tax advice often may be to cash RRSPs earlier than normal to stay in the lowest tax bracket.
Right.
Because when you do die, the whole of the remaining RRSP comes into that final tax return, which might boost you into a higher tax bracket.
Right.
But in any case, as to the legislation, they did have legislation that did pass in June, and now the amount that must be withdrawn for those seniors who are over 71, and there's the date you have to cash your RRSP into a RRIF, the amounts have dropped.
Right.
For those seniors who are less than 70, it's still the same amounts because they're still using the age to 90 mathematical computation.
Right.
So that hasn't changed. It's for the ones that are over 71, or 71 and over that it did change. Another good thing they put into that legislation, because it was passed in June, halfway through the year, was that if a citizen at any time in the year had taken out more than that minimum, they're able to put the excess over the new minimum withdrawal and the old one, they were able to put it back into the RRIF again.
Oh, okay.
Preserve it.
Right.
So it will still be there.
I do appreciate one thing that you touched upon, which is the timing of the pension withdrawals. Nobody likes to pay tax. Everybody with a registered retirement income fund knows if I withdraw $100, I'm going to be paying tax on that $100 because it's added to my income. And since most of the time people don't appreciate paying tax, they will just take out the minimum. I think a point that you were making is it's not just so much the time at which you pay the tax, but the rate at which you pay the tax. And so, as most of our viewers will know, there are graduated marginal rates of tax, and it may well be that somebody has the opportunity to take out another $2,000 or $4,000 or $6,000 at the end of a year, not because they need to do so, but because they can safely do so, but at a lower marginal rate of tax.